Most people think the stock market measures success. It doesn't. It measures belief. Long before profits show up on balance sheets, markets quietly decide which ideas deserve capital and which ones will be starved of it. Roads, factories, chips, energy systems, even wars are funded not after they succeed, but because someone believes they will. Every price you see on a screen is not about today. It's a vote on the future. When that belief strengthens, capital concentrates. When it weakens, capital withdraws often long before the headlines explain why. To understand markets, you don't watch numbers. You watch where money flows, who controls liquidity, and which pressure points the world cannot afford to lose. Because the market doesn't react to reality. It reacts to expectations changing. And that's where real power hides. To understand how financial markets quietly became the operating system of global politics, we must start from the beginning. The modern stock market began in the year 1602 in the Netherlands. At that time, the Dutch East India Company needed money to send ships from Europe to Asia for trade. These sea journeys were extremely risky. Ships often sank, crews died, and cargo was lost. No single merchant wanted to risk his entire fortune on one voyage. The solution was simple but revolutionary. Instead of one person funding a ship, many people invested small amounts of money. Each investor received a share of the company. If the voyage succeeded, profits were shared. If it failed, losses were shared. For the first time in history, ownership of a company was divided into small pieces that could be bought and sold. This system created the first stock market. It was created to raise capital for large and risky projects. Over the next 2 centuries, this system spread across Europe and later to the United States. During the Industrial Revolution in the 1800s, stock markets became critical to economic growth. Countries like the United Kingdom, Germany, and the United States needed massive amounts of money to build railways, factories, steel plants, and electricity networks. Governments did not have enough money to fund everything. Banks alone were not sufficient. Stock markets solved this problem by collecting money from millions of people and directing it to companies that were building infrastructure. From this point onward, stock markets began deciding which industries would grow and which would disappear. A major turning point came after World War II. In 1944, representatives from 44 countries met in the United States at the Bretton Woods Conference. 2 key economists shaped the system: John Maynard Keynes from the United Kingdom and Harry Dexter White from the United States. The agreement made the US dollar the main currency for global trade and global reserves. Because of this decision, global savings flowed into American financial markets. Over time, US stock markets became the center of global investment. This decision, made in 1944, still controls global finance today. It is the main reason why a crash in the US stock market affects almost every country in the world. Now let us clearly understand what a stock actually is. A stock means ownership. When you buy a stock, you own a small part of a company. You are not buying today's profits. You are buying a claim on future profits. If people believe a company will earn more money in the future, its stock price rises. If they believe it will earn less, the price falls. Stock prices move for one main reason: expectations about the future change. For example, if a company earns 100 units of money today and people expect it to earn 120 next year, they are willing to pay more for the stock today. If they expect earnings to fall to 80, they will pay less. This simple rule explains most movements in the stock market. The largest movements are driven by institutions. These include pension funds that manage retirement money, insurance companies, hedge funds, and sovereign wealth funds that manage government money. Funds such as the Norway Sovereign Wealth Fund, the Saudi Public Investment Fund, and China Investment Corporation move billions of dollars at a time. When these institutions change their positions, markets move quickly and sharply. Many people confuse the stock market with the economy. They are not the same thing. The stock market reflects expectations about the future economy, while the economy itself moves slowly. A clear example is the 2008 global financial crisis. In 2007, housing prices in the United States peaked. By October 2007, stock markets had already started falling. In September 2008, Lehman Brothers collapsed. In 2009, unemployment rose sharply, and ordinary people felt the impact. The stock market moved first. The economy followed later. This pattern repeats again and again. Markets act as an early warning system. We saw the same behavior in recent years. In late 2023, global shipping rates collapsed. The Baltic Dry Index, which measures the cost of shipping raw materials, fell sharply. At that time, news headlines were still focused on high inflation, but markets were already signaling that global demand was weakening. This was an early warning. In early 2024, another signal appeared. China's Manufacturing Purchasing Managers' Index fell below 50 between February and April 2024, indicating contraction. Before governments officially confirmed a slowdown, shipping and logistics stocks began falling. Markets once again detected stress early. In early 2025, companies that supply equipment to semiconductor factories, including ASML, Applied Materials, and Tokyo Electron, reported slowing orders. This indicated that companies were reducing future investment. Technology stocks slowed before consumer earnings declined. Again, markets moved before economic weakness became obvious. Inflation is another major force affecting markets. Inflation means that money buys less over time. When inflation rises, future income becomes less valuable. Investors respond by lowering the prices they are willing to pay for stocks. Central banks control inflation through interest rates. Key figures include Jerome Powell at the US Federal Reserve, Christine Lagarde at the European Central Bank, and Andrew Bailey at the Bank of England. When inflation rose sharply after the COVID recovery and the Ukraine war in 2022, central banks raised interest rates aggressively. Higher interest rates made borrowing expensive, technology stocks fell, housing slowed, and risky investments declined. An important lesson from recent years is that markets move on what central banks say, not just what they do. In 2023, when the US Federal Reserve hinted at future interest rate cuts, stock markets rallied months before a single cut actually happened. Markets priced a future that had not yet arrived. War has a powerful effect on stock markets. On February 24, 2022, Russia invaded Ukraine. Oil prices jumped immediately. European stock markets fell. Defense company stocks rose. War disrupts supply chains, especially energy and food. This disruption increases prices. When prices rise, inflation follows. When inflation rises, central banks respond by tightening policy. When central banks tighten, capital becomes expensive and stock markets weaken. This chain reaction explains why wars damage markets structurally, even if they do not cause immediate crashes. Sanctions are another powerful force shaping markets. In 2022, Western countries imposed heavy sanctions on Russia. Russian stocks were delisted from international exchanges. Foreign investors lost access to their holdings. Assets were frozen. When access is removed, prices collapse. Sanctioned countries are forced to build alternative systems. Russia expanded its MIR payment system. China expanded its cross-border interbank payment system. BRICS countries increased trade using local currencies. These systems do not replace the global system. They fragment it. Fragmentation is dangerous because investors no longer know which system is safe. Uncertainty itself becomes a cost. When Russia was sanctioned, Russian companies could not access dollars and global capital markets. They were forced to rely on alternative systems, which made them less competitive and less valuable. Technology, especially artificial intelligence, has become a central factor in markets and geopolitics. This is not a normal technology boom. Artificial intelligence requires physical infrastructure. It needs advanced chips produced by companies such as NVIDIA and TSMC. It needs massive data centers and enormous amounts of electricity. This makes AI a strategic asset. Between 2024 and 2026, markets began pricing a direct competition between regions. In practical terms, markets are betting on three outcomes. They are betting on whether the United States can maintain AI dominance through compute power, capital, and energy supply. They are betting on whether China can build independent AI infrastructure fast enough to bypass restrictions. And they are betting on whether Europe can compete at all or remain dependent on external systems. This is not just a technology race. It is a competition over economic and military power. AI investment is highly concentrated. If major AI companies such as NVIDIA or Microsoft disappoint on growth, capital could exit in weeks, not months. A correction of 30 to 50% is possible because so much money is concentrated in a small number of companies. The US dollar remains central to global power. Oil is priced in dollars. Trade is settled in dollars. Most global reserves are held in dollars. This gives the United States significant influence over global finance. De-dollarization efforts exist, but they are slow and partial. During crises, capital still flows to the US dollar because it is seen as the safest option. If de-dollarization accelerates, the United States would lose its ability to control global finance through the dollar. This is why the US works hard to maintain dollar dominance. For ordinary people, understanding markets does not require advanced financial knowledge. There are three simple things to watch. First, observe where large amounts of money are moving, such as technology, energy, or defense. Second, listen carefully to what central banks say, not just what they do. Third, watch geopolitical pressure points, such as energy routes, semiconductor supply chains, and major trade corridors. If all three of these signals remain stable, the global system is still functioning. If even one of them breaks, the world is not adjusting anymore. It is entering a different phase. To summarize clearly, the stock market is an early warning system. It reacts before governments speak and before people feel economic pain. It prices power, not emotions. Politics, war, energy, and technology decide its direction. If you understand these connections, you understand how the modern world actually works. Thank you for watching. If this inspired you, hit subscribe, like, comment, and share. Be part of our journey. Beyond identities, beyond borders, beyond divisions, our destiny is one. You are watching Next Horizon Global.